Do you think an order block is just a zone from which price can reverse? As a matter of fact, order blocks are traces of large capital. And if you learn how to find them correctly, you can enter the market where market makers enter. Today, I'll show you how to identify valid order blocks, what mistakes beginners make, and what conditions must coincide for an order block to work accurately. And at the end, we will see how to use order blocks in practice and open trades with their help. You have probably noticed that sometimes the price goes sharply to one side, but after a while it returns to a certain zone and then moves again in the direction of the trend. This does not happen randomly. There are big players in the market makers, banks, hedge funds. Unlike retail traders, they cannot just open a trade for the whole volume at once. They need to build up a position gradually and then protect it. Such areas where there was an active accumulation of volume before the impulse are called order blocks. An order block is an area on the chart where a large capital has left a trace. If the price returns to this zone, there is a high probability that market makers will intervene in the market again to protect their positions or to gain volume. Order blocks don't work because price has to bounce off a level. They work because they are places where big money has already been in the market, and their purpose is to protect that area. But it is important to be able to distinguish strong zones from weak ones, because not every order block is worth trading. Before we move on to how to find order blocks on a chart, we need to understand one important thing. There are two types of order blocks in the market, bullish and bearish. A bullish order block is an area where a major player opened purchases before rising. It appears when the price was declining, collected lower liquidity, and then reversed sharply upward. Before this reversal, there is always a last bearish candlestick on the chart, after which a strong impulse begins. Exactly this candlestick forms the order block area. This area becomes a key area because it is where the big players were most likely to go in to buy. If the price returns to this zone, they may become active again and defend their entry. A bearish order block is formed in the opposite way. At first, the price grows, collects the upper liquidity. Most often, it is the stops of those who open sales. Then the last bullish candlestick appears, after which a sharp decline begins. This candlestick is a zone of interest for sellers, and when the price returns to this area, we can expect a reaction. In both cases, three conditions are important: liquidity withdrawal, a sharp impulse, and a clear pullback candlestick that started the move. When these conditions coincide, we get a potential order block, a zone, from where, with a high degree of probability, a big player acted. And now you may ask the question, how to find these zones on the chart? What exactly should we look at to avoid confusing an order block with an ordinary reversal or a random candlestick? Let's understand step by step what signs you should focus on in order to confidently identify order blocks and use them in your trading. In order to learn how to find order blocks, you do not need to come up with complex schemes. The main thing is to realize that we are looking for the trace of a major player, a zone where the price stopped, the volume built up, and then the market impulsively went to one side. First of all, you should pay attention to the liquidity withdrawal. We allocate an order block only if the price collected liquidity before the impulse. In other words, it went beyond the local maximum or minimum, knocked out the stops of retail traders, and only then turned around. If there was no liquidity withdrawal, it's not a valid order block. It may be just a pullback, but not a zone where large capital came from. So when we are looking for an order block, we always first look at 1. Was there manipulation? 2. Were stops taken out? If yes, then we move on to the next step. After that, we look at which candlestick was the last pullback candlestick before the impulse. It can be either a bearish candlestick before the growth, for a bullish order block, or a bullish candlestick before the fall, for a bearish order block. Note, this candlestick does not have to be huge. The main thing is that after it, the market should go sharply to one side without long pullbacks. This movement should leave behind an imbalance, which additionally confirms the activity of large capital. The order block is formed exactly in the body of this last candlestick. Sometimes it is drawn on the body, sometimes taking into account the shadow. If the shadow is long, it can be included in the block zone, especially if there is clear activity on the lower timeframes. Another key point is context. You can't just take any candlestick before an impulse and call it an order as a block. So it's important to take into account the following: where exactly it occurs, what trend there is in the market, and how the price behaves around this zone. If an order block appears after a liquidity withdrawal, on the background of a clear trend and leaves behind an imbalance, it is already a strong zone, which is worth to be considered. And now the main question arises: how to understand that the order block is really working, and what to do with it further. Let's talk about the conditions that strengthen the order block and how to filter out weak zones. For an order block to really work, a candlestick and impulse alone is not enough. We must understand the context in which it appeared. And here are a few conditions that significantly strengthen the order block and increase its reliability. The first is market structure. If an order block is formed in the direction of a trend, its chances of working out are much higher. For example, in a bullish trend, we look for bullish order blocks on pullbacks, and they work most often. But order blocks against the trend can work as temporary reversal zones, but often give only a short-term reaction or do not work out at all. The second condition is being in the discount or premium zone. If the order block is located in the cheap price zone, it is also called the discount zone. It strengthens the bullish block. If it's in the overbought zone, it's called premium. It strengthens a bearish block. This is smart money logic. Buy cheap, sell expensive. Order blocks that are in favorable zones have more chances to work out. The third thing is the presence of imbalance right after the block. If after the order block a strong impulse with a gap in the price was formed, it is a sign that the market moves so fast that the orders did not have time to be executed, and the market is likely to come back to get them. The fourth one is the subsequent change of the structure or updating of the extremum. If the price updates the maximum or minimum after the order block, it confirms that the block was a part of the impulse. Such order blocks are considered structural and are used to confirm the trend. And here it is important to learn how to filter out weak order blocks to prevent entering every zone in a row. Weak order blocks are those that appear without liquidity withdrawal, go against the trend, form without imbalance, or just hang in the air without context. For a block to be reliable, it must be embedded in the market structure. It's not just a candlestick on a chart, it's the behavior of a major player, and we need to see it in action. Now that we understand which order blocks are really strong, let's move on to the most interesting part: how to use them in trading, and what are the ways to enter a trade from an order block. When we have already found an order block, made sure that it is valid, and appeared in the right context, it is time to understand how exactly to enter the trade, where to put a stop, and how to manage risks. There are two main ways to enter from an order block: aggressive and conservative, and each has its own advantages and features. Aggressive entry is a limit order at the beginning of the order block. Let's say we have a bullish order block. We put a buy limit on its upper boundary and a stop loss on its lower boundary. Such an entry is convenient because it does not require additional confirmations. You just place orders in advance and wait for the payoff. But this approach has a disadvantage. There is no guarantee that the price will not break the block deeper. Personally, I use conservative entry more often. Yes, it requires more attention and is not as easy as the limit one, but it gives much more confidence that the price really works out the order block. Here we wait for the price to enter the order block zone and only after the reaction, for example, a change of structure on the lower time frame, we start looking for an entry. This approach is especially good if you trade from the order blocks of a higher time frame, for example, from H4. Then at M15, you can wait for a reaction and get an entry point with minimal risk. And one more advice: try to trade order blocks only at the first test of the zone. If the price has already returned to the order block and bounced, the retest is often already weaker. A big player may have closed part of the position, and the zone will no longer hold the price so well. But if you don't feel confident in your abilities yet, or simply are not ready to spend time on deep analysis of charts, there is an alternative solution. It is a trading advisor MiloBot Pro, a fully automatic system that independently opens and closes trades according to the author's strategy. It is important to understand, it does not use order blocks or smart money elements. It works according to the author's strategy, which was created and optimized for more than 4 years. Over the last 4 years, this expert advisor has increased its account from $34,000 to $270,000. And you can check it yourself on my FX book. All statistics are open. And if you want to test it risk-free, just download the demo version and check the work of the expert advisor on history. You can find the links to the expert advisor and the demo version in the description below this video. Today you have learned how to correctly identify order blocks, what conditions make them strong, and what mistakes most often lead to losses. Now you have a clear base that you can apply in real trading, and this is a small task for you. Open the chart of any currency pair or instrument and find 2-3 order blocks that meet the criteria we talked about. Be sure to take into account whether there was a liquidity withdrawal, whether there's an impulse, and whether there's an imbalance. And try to understand, was this order block part of a big player's move or not? And of course, if the video is useful, don't forget to like it and subscribe to the channel.